landscape of finance isn't just a linear progression. It's an intricate tapestry of innovations, challenges, and revolutions. As we stand at the precipice of another financial renaissance, let's journey back, understanding every pivotal turn that has led us here. Hello, astute scholars of the financial industry. Today we are going to embark not just on a tale of two benchmarks, but on a comprehensive exploration that intertwines finance, ethics, and evolution. So LIBOR's golden age. The London Interbank Offer Rate, also called LIBOR, is no mere metric. Born amidst the pulsating heartbeats of 1980s London, it grew to embody the essence of global finance. Every dawn, a chosen circle of global banks would huddle, whispering their financial projections to each other. These weren't just sterile numbers. These estimates captured their assessment of their own credibility, trustworthiness, and solvency. The culmination of these daily rituals, the omnipresent LIBOR. The London Interbank Offered Rate is an interest rate average calculated from estimates submitted by the leading banks in London. Each bank estimates what it would be charged were it to borrow from other banks. It is the primary benchmark, along with Euribor, for short-term interest rates around the world. LIBOR was phased out at the end of 2021, and market participants are being encouraged to transition to risk-free interest rates such as SOFR and SOFR. But what brought about this need for change? The London Interbank Offered Rate came into widespread use in the 1970s as a reference interest rate for transactions in offshore euro-dollar markets. In 1984, it became apparent that an increasing number of banks were trading actively in a variety of relatively new market instruments, notably interest rate swaps, foreign currency options, and forward rate agreements. While recognizing that such instruments brought more business and greater depth to the London interbank market, bankers worried about future growth, how it could be inhibited unless a measure of uniformity was introduced. In October 1984, the British Bankers Association, working with other parties such as the Bank of England, established various working parties, which eventually culminated in the production of the BBA Standard for Interest Rate Swaps, or BBARS terms. Part of this standard included the fixing of BBA interest settlement rates, the predecessor of BBA LIBOR. From the 2nd of September 1985, the BBARS terms became standard market practice. BBA LIBOR fixings did not commence officially before the 1st of January 1986. Before that date, however, some rates were fixed for a trial period commencing in December 1984. But beneath the radiant shine of LIBOR's gold, there lingered shadows. Initial murmurs of anomalies began echoing in the hallowed halls of finance, hinting at underlying manipulations. What began as sporadic ripples of skepticism transformed into a tempest of revelations. Probing inquiries unveiled an intricate tapestry of deliberate distortions. Stalwarts of global finance, Barclays, UBS, RBS, and more, found themselves ensnared in a complex web. On Thursday, the 29th of May, 2008, the Wall Street Journal released a controversial study suggesting that banks might have understated borrowing costs they reported for LIBOR during the 2008 credit crunch. Such underreporting could have created an impression that banks could borrow from other banks more cheaply than they could in reality. It could also have made the banking system or specific contributing bank appear healthier than it was during the 2008 credit crunch. For example, the study found that rates at which one major bank, Citigroup, said it could borrow dollars for 3 months were about 0.87 percentage point lower than the rate calculated using default insurance data. In September 2008, the former member of the Bank of England's Monetary Policy Committee, William Buter, described LIBOR as the rate at which banks don't lend to each other and called for its replacement. The former governor of the Bank of England, Mervyn King, later used the same description for the Treasury Select Committee. To further bring this case to light, the Wall Street Journal reported in March 2011 that regulators were focusing on Bank of America Corp., Citigroup, and UBS AG. Making a case would be very difficult because determining the LIBOR rate does not occur on an open exchange. According to people familiar with the situation, subpoenas were issued to the three banks. In response to the study released by the Wall Street Journal, the British Bankers Association announced that LIBOR continues to be reliable even in times of financial crisis. According to the British Bankers Association, other proxies for financial health, such as the default credit insurance market, are not necessarily more sound than LIBOR at times of financial crisis, though they are more widely used in Latin America, especially the Ecuadorian and Bolivian markets. The aftermath of the revelations was seismic. Fines reached astronomical sums. They were levied. Legal confrontations sprawled across years. But beyond the intangible trust in the global financial fabric waned. On the 28th of February 2012, it was revealed that the U.S. Department of Justice was conducting a criminal investigation into LIBOR abuse. Among the abuses being investigated were the possibility that traders were in direct communication with bankers before the rates were set, thus allowing them an advantage in predicting that day's fixing. LIBOR underpins approximately $350 trillion in derivatives. One trader's messages indicated that for each basis point, 0.01%, that LIBOR was moved, those involved could net about a couple of $1 million. On the 27th of June 2012, Barclays Bank was fined $200 million by the Commodity Futures Trading Commission, $160 million by the United States Department of Justice, and £59.5 million by the Financial Services Authority for attempted manipulation of the LIBOR and Euribor rates. The United States Department of Justice and Barclays officially agreed that the manipulation of the submissions affected the fixed rates on some occasions. On the 2nd of July 2012, Marcus Agius, chairman of Barclays, resigned from the position following the interest rate rigging scandal. Bob Diamond, the chief executive officer of Barclays, resigned on the 3rd of July 2012. Marcus Agius was to fill his post until a replacement is found. The chief operating officer of Barclays also resigned. Del Messier subsequently admitted that he had instructed his subordinates to submit falsified LIBORs to the British Bankers Association. From the ashes of the LIBOR debacle, the financial echelons yearn for rebirth, redemption, and transparency. The beacon leading this resurgence was SOFR, the secured overnight financing rate. Contrasting LIBOR's malleable foundations, SOFR heralded empirical, tangible methodology. No longer hinged on belief or perception, SOFR derived its strength from actual transactions within the vast domain of the U.S. Treasury repurchase market. As of late 2022, parts of it have been discontinued, and the rest is scheduled to end in the summer of 2023. The last rates were published on the 30th of June 2023 before noon UK time. The 1 month, 3 month, 6 month, and 12 month secured overnight financing rate as its replacement. In July 2023, the International Organization of Securities Commissions said $4 denominated alternatives to LIBOR, known as credit-sensitive rates that it did not name, had varying degrees of vulnerability that might appear during times of market stress. To grasp the revolutionary essence of SOFR, we must dive into its structural intricacies. SOFR isn't a mere snapshot. It's a cinematic reel capturing real-time financial dynamics. Grounded in the tangible realm of Treasury-backed overnight transactions, it paints a genuine portrayal of market sentiments. SOFR is an interest rate benchmark, also known as a reference rate or a benchmark rate. SOFR is a broad measure of the cost of borrowing cash overnight collateralized by U.S. Treasury securities and represents the near risk-free rate. SOFR measures the cost to a bank of borrowing cash overnight and so represents the amount of interest that a bank will have to repay to the lender the following day. SOFR was published in April 2018 and is administered by the Federal Reserve Bank of New York. The rate for a given business day is published at 8 a.m. Eastern Time on the following business day. SOFR is the Alternative Reference Rates Committee's preferred benchmark for transition to U.S. dollar risk-free rates from USD LIBOR. Differences between SOFR and LIBOR. SOFR is described as a risk-free or near risk-free rate, as unlike LIBOR, it did not contain material term risk or bank credit risk. SOFR is an overnight rate which is published in arrears. In contrast, LIBOR is a term rate which is published at the start of the relevant period. This means that for products referencing SOFR, unless adjustments are made to the methodology, the actual amount of interest payable is not known until the end of the agreed interest period. SOFR is based on repo transactions which are secured. In contrast, LIBOR is an indication of the average rates at which banks could obtain wholesale unsecured funding. So how is SOFR calculated? SOFR is calculated as a volume-weighted median of the transactions that are involved in borrowing cash overnight, collateralized by U.S. Treasury securities, also known as repo transactions. The paradigm shift from LIBOR's mazes to SOFR's transparent corridors isn't merely a change in terminology or metrics. It encapsulates a profound transformation in global financial ethos and strategy. Our voyage through financial epochs serves as a potent reminder that finance isn't just about numbers. It's about vision, values, and evolution. Let us pledge to not merely witness, but shape this exhilarating future. If you want to learn more about investing, you should join the Benjamin Z. Miller Investor Networking Group. You can meet investors from around the world at our weekly meetings. For more information, just email ben@benjaminzmiller.com. I hope that helps, and good luck with your investing.